with that, it transitions to maybe another question we were going to talk about, which, we have different programs out there. There's different restrictions. One thing I'm always getting is, talk to me about, what your max payment is or what your max price point is,
Hmm.
and we need to be around 450. Totally fine. But let me ask you this, are you guys going off the price point? Or are you guys more concerned about your monthly budget? And when it starts getting to that subject, a lot of them are kind of not really understanding, what the monthly budget realistically will look like, especially with these interest rates kind of fluctuating as much as they are,
Hmm.
and so I kind of try diving into different programs regarding PMI.
Hmm.
If you could dive into what that is real quick, but then also maybe some different ways that people aren't really aware of that, you could get a little creative on how to remove it. Obviously, the 20% rule is kind of what a lot of people know about. So if you could jump into that, that would be awesome.
Absolutely. So, a couple of topics there is some people come in and they say, hey, we want to be at the 450 price point. And, when I hear that, my first question is where did 450 come from? What is it about the 450 price point that's important to you? And, what it boils down to is really three things. What is your cash out of pocket target or goal? Meaning, how much do you have available to come out of pocket to get into the house? Is it a percentage of the house? 10% of 450 is 45,000. Maybe the buyer says, I've got 32,000. The next thing we're going to look at is monthly payments. What are your targets for monthly payments? Do you want to be at 2,500, 3,000? What, really, where is your target there? And then the last thing is, how long do you plan on being in the house? And that has a lot of importance, especially when we start talking about less than 20% down with mortgage insurance. So mortgage insurance is an insurance policy that is tied to the loan that protects the lender in the event that the borrower goes into default. And so that's an insurance policy that the homeowner, the borrower, has to pay to protect the lender. A lot of buyers don't like having that on the monthly payment. It increases their monthly outflow. And so they always ask, how do we get around that? Back in the day, we used to do first and second mortgages, like an 80-10-10 for a 10% down loan. You do it 80% first, 10% second, or an 80-15-5. Rates on the second mortgages are a lot higher than what you'll see on the first mortgage, so it's not always the best thing to do. And then we look at mortgage insurance. Most people view mortgage insurance as a monthly requirement. We actually have an opportunity to prepay mortgage insurance upfront at closing. And the benefit to that is if you're over 700 and even more so over 740, the upfront cost of mortgage insurance, when you do the math on, hey, if I spend a couple thousand out of pocket at closing versus a couple $100s per month every month until it goes away, where's my break even period? When we start doing the math on upfront PMI versus monthly PMI, you're going to see break even periods around the 3-year window. And that's where we start looking at a loan where maybe somebody wants to put 10% down, and we look at the monthly mortgage insurance and it's adding a couple $100 to their payment. Well, maybe we do 8% down and we take that 2% and the other 2% that you have access to, and we buy out the mortgage insurance that's going to give you, it's going to pay itself off in 3 years. And then maybe we do an interest rate buy down that you're going to save interest on for the life of the loan. And
Right.
so when we start talking to your customers, it's really, what do you have access to for cash out of pocket? Because that $450,000 target buyer might say, I've got $90,000 that I want to put down and I want to do 20% down. And I can't tell you how many times we've done this. We've presented an option where they do 15% down. So they
Yeah.
keep 5% in their pocket. It's $22,000 they keep in their pocket. We prepay mortgage insurance, which is a few $1,000s at closing. We'll do a little bit of an interest rate buy down, and they can almost have the exact same payment as they would on the 20% down loan. Maybe it's a little bit higher, but they end up keeping $15,000, $17,000, $18,000 in their pocket after closing. And the monthly payment difference versus 20% down is negligible. It's so small. And it gives the buyers a nest egg. It gives them those reserves. It gives them money to, customize the house however they want after the fact, the furniture, the TVs, any other accessories that they want. And when they really see that we can move things around and get away from a 20% down payment to a 15 or 10, get rid of the mortgage insurance, buy down the interest rate, it saves them thousands over the life of the loan.
It's huge. I mean, that is probably one of my number one closing techniques, is really kind of diving into those numbers, because if you understand the financials, I mean, it kind of really opens the eyes of buyers. Even some realtors are still kind of not really understanding this, and it's something that took me a while to can even get a grasp on. But I mean, like for example, I mean, the rule of thumb I've always been aware of and kind of heard of is like for every 10,000 you add into, a 30-year note, it comes out to about 60, $80. And I feel as though from what I've seen typically, like an average PMI or MI that you're going to be receiving is anywhere between like 200 to 250. I mean, even on like a, 200, I mean, you're saving what, like, you know, 25,000 roughly, off the price if you're able to remove that. And again, you save yourself so much pocket money. I mean, you can put that towards furniture, you can put it towards buying down the interest rate. So many things that collectively can not only save you money, but keep additional liquidity within that account. And it's a huge thing. So yeah, I'm really happy that you're able to kind of go into that and help kind of provide further insight. I mean, I think that's an incredibly important topic for a lot of people to understand their affordability.
And
Last,
most people don't know it's available. So I'm so happy you're bringing it up. I have a customer that we're going to close next Friday.
yeah,
He wanted 20% down. His wife works in the salon business, and she's been out of work the past 60 days. And so he and I started talking about different loan options, and he's like, "Well, I really don't want the PMI, but I'm worried about putting 20% down." And I
right,
said, "Well, let me show you this option." So I showed him 15% down. We did upfront mortgage insurance, which cost about $1,500 at closing. We did a little bit of an interest rate buy down. We took him from 3.6 to 3.2, and he's keeping an extra $13,000 in his pocket, and his monthly payment went up like $40 from that
jeez,
extra. And when he looked at it, he said, "I had no idea we could even do this." And so
yeah.
it's truly using finance as a tool. How do we use this to make your overall financial budget work best for you?